How to break into commercial property. What is the playbook, the step-by-step guide? Joining me to discuss is Carl Burling and Jack Revill from Provincia Commercial Property. How are you guys?
Good.
Thank you.
Fantastic. Cool. Now, the whole topic of commercial property can be a little bit daunting for those that are engaging with it for the first time. Let's just go through the basics to get started, starting with the subtypes of commercial property, because it's not just all one homogenous good. Yeah, so correct. Jack, do you want to start with that one and just tell us the different types?
So the base three categories is retail, office, and industrial. That's your three main categories. And then from there you have subtypes below those. So you've got your office, you've got prime office, A grade, B grade, C grade. Occasionally you might class some as D grade. You've got your industrial, which is your prime or secondary. Secondary is still really good because they're really hardworking. That's our preference. We love industrial. Retail as well, you've got urban, and then you've got suburban, and then you've got malls as well in your retail space.
Okay.
So.
And that shouldn't be a surprise, I guess, for a lot of people who know if they're in the residential space, you'll have different types. You'll have freestanding townhouses, apartments, all that sort of thing, right? So,
exactly.
And when we zoom out and we just think about commercial property versus residential property, what are the key differences between commercial and residential?
Well, I think the biggest thing is with residential, it's normally where you start in property investing, and you can quite often leverage off your own home and buy a couple of rentals, and you're in there for the long term. So it's capital gain, that's what you want, and you may get some tax advantages. Once you start getting a little bit older like me, you want more cash flow. Yes. So maybe cash in a few of your residentials, leverage a bit more to buy commercial property, which will give you true cash flow, real money to live off, rather than getting those capital gains.
So thinking about the barriers to entry, whether it's actual capital or whether it's education, what are some of the general barriers to entry with commercial property investment?
I think it's definitely a combination of the two. The access to capital, or having that equity. You need a bit more equity to get into commercial. Generally speaking, you need at least a 30 to 35% deposit. So that's a bit more than your residential. That said, you can leverage, as Carl mentioned before, you can leverage off your residential portfolio to get into commercial. The other sticking point is that knowledge. You've got to make sure you know what you're investing in, you understand commercial property, and you understand the leases. Because any mistake in those leases or any parts of those leases that you don't understand can cost you big time in the long run.
Do you want to just take through maybe the top 3 points of what would be in the lease that people should be aware of?
Definitely. So you got the first schedule, which is generally your terms. So you got to understand how those terms work. So your initial term, your commencement, your renewal dates, your right of renewal. So those are your pretty standard things. Then you got your second schedule, which is all your definitions. So what has been changed in those definitions? So you need to understand what of those definitions in the lease agreement has been changed. This is a standard ADLS, Auckland District Law Society agreement. What's been changed? Because those minor changes can massively change the entire performance of that commercial property. Sure. And then the third schedule, which is the clauses that have been added at the end of the lease.
Sure.
And that can be anything.
Okay.
And one of the real keys of understanding the lease is to use it to your advantage. So what Jack and I do is we find properties that have very weak leases, and we basically fix them up by changing the lease.
Yes.
And by doing that, you can add huge value. The big difference between a tenancy agreement is a residential tenancy agreement is that you're stuck with that. That's the rules. You have to abide by the Residential Tenancies Act. But with a commercial lease, you can put anything in there that you like. And if you're getting a new tenant, you can write a new lease that's mostly to your advantage.
And so when we're thinking about investment returns, you can have your returns a couple of different ways: capital gains or cash flow, yield or gains, right? So with residential property, often those two are inversely connected. If you buy a residential property for really good rental income, you're generally going to take a hit on long-term capital gains and vice versa. So with commercial property, how does it work? And are the returns generally better? I'm using my air quotes here as well. Are they really better, or is it just different?
Oh, definitely better returns, because it's about the cash flow. So you get a better net return. So that's primarily the main difference. So with your residential you get really good capital growth. You do that with commercial as well, but it's influenced by the ability to renegotiate the lease or get a better arrangement with the tenant with commercial property. And as I mentioned, that cash flow is net as opposed to residential being gross. Now, what I mean by that is with the residential, you're paying you got to pay rates, you've got to pay insurance, you might have to pay the management fees, you might have to pay the water or the fixed charges for the water. That's with residential. So that's all coming off what the return you're getting from the tenant or tenants. With commercial, generally speaking, that is charged to the tenant. So the tenant pays your management fees, your insurance, your rates, your water. It's all paid by the tenant.
Wow.
So
what about things like body corporate fees?
Body corporate fees paid by the tenant. Your return is better in terms of cash flow.
So you take care of that envelope and everything else that's on the tenant.
Exactly.
And with the interest expense, which is often the biggest expense associated with owning a property, obviously that's going to be borne by the owner of the property. We can't expect the tenant to pay that. That would be like a dream, wouldn't it? What planet does that exist?
We haven't invented that lease yet.
No, that would be great.
The one lease we do have, which is actually very strong for the tenant as well, they've got a lot more control over the building, is a triple net lease. So what we mean by triple net is, we call it a triple net. That's when the tenant pays the rent, the outgoings, which is the rates, insurance, management fee, which we just touched on, but they also pay the capital expenditure. So any capital works that needs to be done on the property, i.e. roof maintenance, site maintenance, they cover all that. So that's the strongest lease you can get. But the flip side for the tenant is they've got more control over the site. They run the site how they want. They've got more control of what they're doing with the site. They still have to ask the landlord permission if they want to extend or make changes to the site, obviously. But they've just got a lot more security and control, which a lot of tenants do prefer.
So the standard District Law Society lease stipulates that the tenant must pay certain outgoings, but it's not normally for the outside part of the building. That's normally the landlord's responsibility, so to do the painting and re-roof. But with a triple net lease, that's the tenant just takes care of everything.
Okay.
And they're almost like a set and forget because the tenant does everything.
Right. So from the tenant's perspective, they still have to go through processes when they're doing improvements and all the rest of it, but they take full responsibility for all of the costs.
Yep.
And the only thing that they're not having to worry about is the capital to come up with and the ongoing obligations to the bank, apart from the improvements that they add.
Yeah, correct.
It's really like an in-between owning it and not owning it situation.
Exactly.
And the sale, most of those types of leases we've done as a sale and leaseback. So the tenant has been there as the owner and we've gone and bought the property. So we get to write the lease, the best lease that we can get. And the tenant likes it because they've normally been there and owned the building in the past. So they still control it, as Jack mentioned before.
They're just unlocking equity.
Yep. And typically they would put that equity back into the business. And that's what we've done with our last 3 sale and leasebacks.
Interesting. So if there was a business that was going through a growth cycle and they had the foresight at the beginning to own the property that they were running their business out of, but they were strapped for capital at some stage, they could approach the likes of you and do a sale and leaseback arrangement where they continue on operating their business, but they've just unlocked the equity. They've sold the building, but for all intents and purposes, no change to the outside of what it looks like their business is. And I guess that gives you a little bit of an insight just to how powerful the property market, or I guess we'll call it the land market, to remove all that, is to fund growth. Like we kind of look at the residential property market and the small business owner as somewhat symbiotic in that as property values increase, the plumber, the builder can go to the bank, top up their mortgage, buy a new ute, expand at a very small scale. But this gives us an insight as to how it would work, not using debt to fund expansion, but using equity, basically by selling a portion of the business, which is the asset, which is the house that the business is operating in, right? I think that's interesting.
Yeah. And it's quite common in the industry right now, which is really cool to see.
Is that because that it's harder to access capital?
Well, I believe so, and the cost also to access capital, the cost of borrowing right now has been quite high. So we've seen that in the last 2 years of a lot more sale and leasebacks.
Sure.
Which is really interesting to see.
And I guess the opposite of this would be where, as a building owner and a business owner, you might sell the business as a going concern. That then moves elsewhere or stays in the same place, but then you stay on board as the owner of the building itself, and that's your passive income in retirement, right?
Yep, we've seen that done as well.
Right. So with commercial property, what are the types of risks that investors ought to be aware of before they go too much further with it?
Well, it is quite different to residential. Generally, if you've got a residential property in a good area and it's clean and tidy, you won't have problems getting tenants. In both residential and commercial, your biggest risk, not having a tenant.
Yep.
You lose your income. But you can cover yourself by putting certain clauses in the lease, getting what we call bank bonds or bank guarantees. In the past, it has been personal guarantees, but they're very, very hard to enforce these days. Most people have their personal assets tied up in trusts, and they're generally quite hard to get to. So what Jack and I do is, with most of our new leases, we prefer to have a bank bond in place.
How does a bank bond work?
Bank bond is basically in favour of the landlord. So it's a document that's provided for by the bank of the tenant, right, which stipulates it's in favour of and states the name of the landlord. So if it's one of us or our business or our property fund, it's got that property fund. And we get the document from their bank stipulating that this is the bank bond, and the amount is, generally speaking, it's 6 to 12 months of the rent. So depending on what's been negotiated in the lease, and that sits in the landlord's favour. And what that means is that if the tenant ever defaults on rent or is late on rent, then we can activate that bank bond, which means we can go to that bank based on that certificate and claim that amount of money.
I see.
So the way the tenant sets it up is basically it's a facility that's ready there based on maybe some assets that they own, but it's in favour of the landlord. So if they're say having a bad couple of months, business isn't going that well, and they skip a payment in rent, Jack and I can just phone the bank and say, hey, we want to activate the bank bond, and pretty quickly the rent turns up. So if something really bad happens, we know that we've got 12 months of rent prepaid, and that gives us time to find a tenant. So it removes that risk of having a vacancy.
Good.
Yeah.
And I guess it's not too different from tenancy services where you'd pay a bond if you were a tenant, right?
Yeah.
Except it's much larger here, and it's not operated by a separate organization. It's operated effectively by your bank, the custodian of that money.
You can do it in a way where you have a cash bond as well. So that's a cash bond which the tenants do pay up front, which sits in the landlord's account, essentially. Okay. So that's the other way to do it. Generally speaking, you probably wouldn't get 12 months in advance for a cash bond. You might get 6 months. We've got a few in our portfolio that are 4 and 6 months of cash bond rather than a bank guarantee. So rather than setting up that facility.
What would be some of the other risks apart from the tenant not paying the rent?
Yeah.
What like vacancy, I think would be the next biggest one that I would think about.
Absolutely, the vacancy risk.
Yeah.
That's your biggest. So, and I mean the way to mitigate that is, well, you've got your tenant. If the tenant is really in default and you've got to change the locks and remove the tenant. We like to think a lot of the properties we look at or that we invest, we look at industrial that's in really good areas. So areas that are high demand with low vacancy. So that means that it gives us the ability, should a property go vacant, the tenant leave for whatever reason, or the tenant just wants it, comes up to renewal, doesn't want to exercise the renewal. That's the other thing, is they've got to give at least 3 months in the standard Auckland District Law Society lease to renew the lease. So generally speaking, you will get 3 months notice. And we have really good relationships with our tenant, and the new Auckland District Law Society leases provide that they've got to give more notice now. So 6 months notice. So you've got 6 months notice that, hey, what are you doing to renew the lease? Okay. And if they're going to leave, you've got 6 months to find a new tenant. And generally speaking, the areas our properties are in, which we do a lot of due diligence on, and the type of properties we've got are actually quite high demand.
We're very, very strict in the areas that we invest in, and they're always high demand. So we very, very rarely have a vacancy, and there's maybe, I think the longest we've had is a few weeks in between tenants, changing tenants, and quite often Jack has them moving in, shifting out on the same day, which can cause problems because he doesn't like vacancy.
No, that's good, but and it makes sense, right? Like I guess you always want to get return on your investment, and vacancy feels like the biggest threat.
It is, yeah,
and it feels also like, because it's kind of linked to the business cycle, the economy, certain periods of time probably represent higher risk than others, but sounds like the way that you mitigate that risk is by choosing location. You mentioned the bonds before as well. So you kind of are buying buildings in areas where you know that if they can't perform, chances are somebody else in the area might.
Yes.
And we found one of the biggest mistakes a commercial investor can make is to chase high yield by
Interesting.
going into areas where, yes, there's a high yield, but then when you lose that tenant, you may not have a tenant for 12 months. Say if you go out to some of the provinces, you may get a 2% better yield than some of the areas we invest in. But if something happens to that tenant, you're left with an empty building for quite a long period. So that's really important to invest in the right areas and don't chase really high yields.
If you're chasing high yield, you're chasing a tenant who was willing to pay that, but that was an anomaly, not a normality, right?
And the way Jack and I get high yields is we basically buy a property that maybe hasn't got the best yield, but we can see that underlying upside in quite a short period by tweaking the lease or doing something for the tenant, providing a bigger floor plate or extra warehousing. That way, that's how we can really tweak the yield, even in the good areas.
Yeah.
Or buying under rented.
Yeah,
That's the shortcut.
That's his forte.
Okay. Yeah. Well, do you want to unpack that a little bit? So when you say buying under rented, because one of the questions I wanted to ask you is the difference between yield and cap rate.
Yeah.
And I'm guessing it has something to do with this. So
yeah, exactly. So we look at properties when we're doing that due diligence as well. We're looking at the areas, but we're also looking at what is the market rent. So it's very similar to residential. You've got a market rent that those residential tenants based on how many bedrooms it's got in that certain area that they're paying. It's similar to commercial. So commercial's got a per square metre rate, we call it, and that's based on the market in that particular area, and for the type of property as well. So if we're talking industrial in South Auckland, there's a set per square metre rate in different areas in South Auckland as well. So what we're doing as part of our due diligence, and when we're looking at the properties or sourcing properties to acquire, we're looking to find properties that have a lower than market square metre rate that the current tenant's paying. So that might have been a lease that was negotiated several years ago or 3 years ago, and the landlord might have just really wanted a tenant in, reduce the rent at a lower than market rate, and that's what they've set it at. So if we can buy a property for a good yield on a lower market rate than what is in that area, and we know there's a market rent review which is built into the lease coming, or even fixed rental increases or something coming, so we can see that rental go up in the future. That's the best way to add value, because if you've got property that's got a lower than market square metre rate that you can just easily tweak the rent on in the future, you're going to add a lot of value to the property as well as cash flow.
Because it's a formula, right?
Exactly.
So if you adjust one, you affect the other. So if something's already below market rent, even just the act of renewing the lease, bringing it to market rent, instantly increases the value of the property.
That's exactly it.
And so then you overlay the other things that you could do by partitioning it a little bit better and adding an extra tenant. Or
tidying up the building, giving the tenant something that they want that Carl mentioned before. So trying to tweak the lease somehow that the tenant might want extra space. They might want a sealed yard. They might want to widen the yard. They might want the certain areas tidied up, like the office area, to get better square metre rate on the office. So it's that negotiations.
So it's key to know the square metre rates for the areas that you're investing in.
Sure. How do you find that out?
So we're very close to our valuers.
Valuers, yeah.
And so we can pick the phone up, and Jack can pick the phone up and say, what do you think about this property? Is it under rented? What do you think of the lease? Where's the upside? An example might be you're buying something for $100 a square metre, industrial property, but the market rent is $150, and that the next rent review that you will be able to achieve that. Even though the perceived initial yield might be lower, you know that you're going to be getting a higher yield in time by tweaking the lease and having that rent review.
You still have to buy it and honor the existing lease that's there.
Yes.
So I guess part of the due diligence is you're trying to figure out whether or not that tenant is good for it. Like, would they actually be able to do that?
Yep.
And so how much due diligence would you need to do on the actual tenant, the business itself, when you're buying commercial?
A lot. We do dive into that a lot. Like, there is a lot of due diligence to be done on the building itself as well and the market, but we do a lot of due diligence on who the tenant is, how they're operating, what their forecasts look like, what they're doing.
Can you squeeze any more juice out of that lemon, right?
Yeah, exactly.
Yeah. And so you can actually, when you're buying a property, you can request the tenant's financials and basically see if they're a good business and if things are running well. And that's quite key. And what we have a 38-point check now, don't we,
Yeah,
Jack?
38
On
points,
our due diligence list. It's very, very thorough.
So if you were going into buying an entire property yourself, one of the big things, or even just a slice of it, I guess, but one of the big things you'd be concerned about is how easy is it, can I get my money back out of that if my circumstances change? Like obviously if you're an investor, long-term makes sense, but that's not always the case. So liquidity or the ability to convert that investment back into cash is key, right? How liquid is property in the commercial space?
I guess it depends on the class of commercial property that you're going to buy. So industrial right now, there's a high demand. There's a high demand for, there's a lot of investors right now wanting to park their money in industrial property. And there's also owner-occupiers as well. So owner-occupiers businesses that want to buy the buildings so they can operate their business from. So we've seen in the last year a very, very high trend of owner-occupiers acquiring industrial property as opposed to office and retail.
Oh, it also comes down to the area. That affects your liquidity and the quality of the lease. Say if you were going to an auction and you had a very short-term lease and the tenant wasn't very good, but you're still in a good area, you may struggle getting people to turn up to the auction. But if you have a good tenant, a really strong long-term lease in a good area, you're going to get a lot of people turning up to the auction. Right. And in that case, it's a very liquid investment.
And I guess like with any market, right, you'll have a pool of buyers, a pool of sellers. So if it's bad liquidity, but there's a lot of demand and a limited supply of stock, well, that's actually a really good thing as well,
Exactly.
right?
Yeah.
Do you see that often? Like, especially during COVID, when there was a big push for, I guess, industrial, did you see that there wasn't enough stock for the demand that was out there?
Hugely. It was every investor was trying to jump into industrial, and all the businesses needed more space and more stock for industrial, and there's just a shortage of industrial property at the time.
And it also wasn't conducive for developers at the time.
Of course.
And it still is not great for developers in terms of the cost to build. So that's really good for long-term holders like us. Also, demand and liquidity is also dependent on the value of the property. We find that properties up to 1 million in commercial, there's really high demand. They're quite liquid. Then you start to get up to the 2 million. So, liquidity is a little bit less. But once you start getting over 3, 4, 5 million, they might take a while to sell, but it's just different buyers. So you have to, attract the right buyer that can afford,
right,
3 or 4 or 5 or 6 million.
Right.
And it will just take longer.
And as a fund, as a commercial property fund, do you target properties within a certain price band partly for that reason?
Yeah, we got a really good mixture. That's primarily the reason, and we also like having those larger tenants and those bigger tenant covenants as well, rather than dealing with a lot of smaller operators. So that's part of the strategy with the fund. So our fund strategy is to look for properties that are in that 3 to 10 million price range.
Okay, that's good.
And that is mainly because of the tenancy risk. If you start to getting into the $20 and $30 million properties with one tenant, it takes a while to find a tenant like that in the future if that one moves out. But if you got a property that's 3, 4, 5 up to 10 million, we find that it's easy to find a tenant, and even better if that $10 million property is multi-tenanted.
If you do take a hit, it's really just a fraction of a hit rather than a full hit, right?
Yeah. And that's the beauty of the fund, because we have 14 properties spread over and with 23 tenants. If one tenant leaves, you're right, it's a small hit.
Yeah.
If you've got multi-tenants.
Good. So going back right from the start there, like there's barriers to entry to any investment type, and one of them is capital. Like how much money are you bringing to the table when you're buying a property? And for any property purchase, you can fund the entire amount or just a small amount and then find a partner, often in the form of a bank. So as it relates to some of the lending criteria or the rules that a bank will set when approving money to buy commercial property, what can you tell me about what those rules are? Like, is it as simple as what it would be by like going to your own bank to take out a mortgage, or a bit more nuanced, I suspect?
It's a lot more complex. And so the bank will look at obviously your income, your assets, residential, commercial, and they'll look at your servicing ability, similar to residential. And basically they'll get a much sort of stronger picture of your financial situation, and they'll want to look at the leases as well for the commercial property that you're contemplating looking at, and they may even look at the tenant, and they look at risk of tenant default as well. So that's a risk that they don't get paid their interest.
So it's not just, hey, what's your income, what's your expenses, what's your equity? It's more like, no, show us the lease. Like, let's actually have a look at the financials for the business. That's the tenant. Everything, right? They want it all, including like a valuation report, presumably.
Yep. If they're securing against the asset, they definitely will have a valuation report.
Right. But quite often, like I think you said at the start, Carl, like quite often people might have a residential portfolio or at least one property, and that makes it a little bit different yet again, right? Because the rules around their family home will be very different to their investment property that's commercial, right?
Yep. And they also look at all sorts of other metrics, especially in a fund arrangement. So one they look at is it's called interest cover. So they want to know how many times the rental income of our fund will cover the interest. So typically they will want 2 times.
So like if they had $10 million overall of rental income coming in, if you as a fund had $10 million coming in, but your interest cost was only $5 million going out, that's kind of what they're looking for, right?
Yeah. So they would set that as a minimum. So we typically operate around 3 times interest cover. So they see us as quite a low risk, and they also look at the loan to value ratio for commercial, like they do with residential.
What is the typical loan to valuation ratios if there was no residential property?
It varies. They'll go to a maximum of 65%.
Okay.
With a fund, they'll go to 45%, and we typically sit around about 40%.
That's almost analogous to the debt to income ratios.
Yes.
Right?
Yep.
Yes.
Because they're looking at income relative to your overall debt load.
Exactly.
And then the loan to valuation, that's just representing the amount of equity you bring into it. Let's assume they give you the loan. What are the repayment terms like? Are they going to give you interest only? Are they going to give you 30-year term?
So it depends. If it's a individual, so securing against the asset, generally speaking, it's paid back. Or you can have certain periods of interest only, but generally it's a 15-year term. So it's a lot shorter than your residential 25, 30-year loans.
Yeah.
Yeah, so P&I.
Yeah, P&I, yeah.
And then they might give interest only as well?
For a period.
Yeah, but I guess you'd have to be really careful if it was a 15-year underlying term, because as soon as your interest only expires, you've got the rest of that shorter principal and interest term to deal with, right?
Yeah.
It's quite a good discipline because it's forced saving. And end up at retirement and you've paid it off.
Yeah, it's good as long as the numbers work on the way to retirement, right? And I guess that would be the challenge, and that's probably why, even though it might be frustrating that you have to come up with a large deposit, like say up to 35% or even more to get in, that's good because your payments are going to be paid off over a much shorter term, which means that you can't really rely on all of that rental income in the same way that you might elsewhere, right?
Yeah, definitely. And the interest rates are slightly higher for commercial as well. So if you're securing that security against a commercial asset, the banks will charge you slightly higher rates than they do for securing against a residential property, which again is why a lot of investors will leverage to start with off their residential property to get those residential lending terms as opposed to commercial to get into the market.
Like in a perfect world, they'd top up their lending on their entire residential portfolio and just pay cash.
Exactly.
Or in other words, not use the commercial property as security, just use existing security, which is residential. But what is the typical loading, or what does the higher interest rate look like? If it was a 50% loan to valuation ratio, somebody buying a standalone commercial property with no residential property, what typically do you hear about?
Generally speaking 1% to 2% higher than your standard residential rates.
Sure.
So.
Okay. Which is kind of like I would stand back from this and I would look at this as the bank saying, well, we want to wet our beak on some of this action, right? Like this is obviously a good proposition. So sometimes the higher costs are there and the higher restrictions because it's more risk. Other times it's there because there's actually more return.
Yes.
And those with the gold make the rules. We do live in a banking cartel. Forgive me, banks, for saying that, but oligopoly cartel, tomato, tomato. So is that, in your perspective, is that kind of why you think that, like this is not, from what I'm hearing so far, it's not necessarily a riskier proposition with commercial, right?
Definitely not. It's definitely not riskier as opposed to residential because you've got fixed term leases as well, and bank guarantees or cash bonds. So it does that de-risk it. It's
Yes.
just you're paying a slightly higher interest if you're securing it primarily against that
But
commercial
the
property.
best way to get into it, and we've done it that way in the past, is to leverage off your own home,
Yes.
and that way you're getting 5.5%
Yes.
interest rate,
Yeah.
rather than 7.5.
Cool.
So it really makes sense if you're buying a commercial property that's yielding 7.5%,
Yes.
and then your debt is at 5.5 because it's secured against your own home.
Right. And this is why it's so important to think about this as a playbook, right? It is a strategy that will unfold progressively through time. It's not necessarily something that you just start out doing. Like some people can, if they're in that position where they can come up with a cash deposit.
Definitely, yeah.
But it is a playbook, right? Because the strategy may be to own your own home first, maybe own a residential property, build up some equity to a point where instead of scaling up your residential, you now leap into commercial by leveraging up there to put that into commercial, and that's like second gear now.
Exactly. Yeah, we've had so many of our clients, because we help a lot of our own clients get into commercial as well,
Yes.
as well as our property fund, and both are options to our clients. But that's exactly what a lot of our clients have done to get into the commercial property, and then that starts them once they're in the commercial property, they start building their portfolios in commercial.
And you don't look back generally?
Generally speaking,
Yeah.
they start to sell off their residential. Carl and we've sold off our residential.
Is that right?
Yeah.
Because I think the first time I talked to you, Jack, was when I think you bought your first place when you were 21?
Yes.
Your first
that's correct.
residential?
Yep.
And so you kind of followed this playbook then, didn't you?
I have,
You
yeah.
built equity through residential, converted it to commercial, sold off residential.
Yeah.
Now you're commercial only.
Yeah, I still have one block of flats left, but that's it.
Okay.
So I've sold off all the other residential and just primarily commercial,
Good on you.
aside from the block of flats. So
Okay.
And the key thing is you just read every book that you can read on commercial property.
Yes.
Listen to podcasts like this, and then you start to get that knowledge base before you start to dip your toes in.
Yes.
And another good way to learn is also buy a couple of shares on a listed company, and suddenly you start learning the language of commercial property.
Yes.
Because you can read annual reports and start to really understand what you're investing in is the key.
Nice. Anything else about the interest rate piece, though, that you want to mention?
Yeah, so it is dependent on the LVR, so it's how much you're borrowing. So banks are quite lenient in terms of having an interest-only period, which Jack talked about, but it will be normally based on their risk to do with the loan-to-value ratio. So with our fund, because we're only at 40%, our lending with our bank for the fund is interest-only, so that is great for cash flow.
Right. So do you roll that interest only over continually? Is that one of the? I guess that's a strategy to, I guess, pass through returns more efficiently, but also there's probably a bit of a risk there in that lending policy now poses a risk in that, for whatever reason, if there's a change to the lender's policy, they might say no more interest only. You're gonna have to start paying this back, and I guess if you can't get that lending refinanced elsewhere, is that a serious risk, or is that something that you've never had that problem? Because
We've never had that problem, but with any banking, that's a remote possibility. But what we've found with low loan-to-value ratios is that banks are very, very supportive in terms of carrying on that interest only,
yes,
especially looking at some of the bigger funds out there.
Yeah.
They'd rather pass the extra cash on to investors rather than pay down the principal.
yes,
And the good thing about commercial property is we're always adding value, so that LVR naturally comes down, and there's also the market forces too. So if we just sat on our current fund, the LVR will naturally reduce itself over time.
So does that mean that from a long-term sustainability point of view, does that mean that as a fund, it might be safer to build wealth through a fund as an investor or as a direct investor?
The main reason people get into a fund or a listed company is that they're spreading their risk rather than buying the one property on their own or two properties on their own. So I mentioned before that our risk is spread over 23 tenants. So that's the main reason. And the other reason is that they don't have the expertise. with our team, there's Jack and I, and we've got 4 other directors who are experts in different fields, finance, property, commercial finance markets.
With commercial property investment, like after you've done your due diligence and you've secured the property, how do you create better cash flow and better capital gains?
So the best way is to have those, make sure you've done the due diligence and you might have established that the property was under rented. So that's probably your number one. And you're sitting on it, you've bought the property, you've inherited the lease. So you've got this tenant sitting on a strong lease, and you've got a market rent review in, say, a year's time or 2 years' time. So you've got that cash flow coming in. You can go and renegotiate the lease earlier with the tenant. So that is an option. But if the tenant doesn't want to renegotiate, then you wait a year, 2 years, and then the easiest way is to do that market rent review, get the rent up to market, and that's going to increase your cash flow because it was under rented.
Yes.
So that's the easiest way. And then you've got that increased rental, and that's going to reflect in terms of capital gain. That's going to increase the value of the property because you've now got a higher rent. The value will apply when they do their valuation, a capitalisation rate to that new rent, which increases the value that they
And
put on
that
the property.
capitalization rate or cap rate will be specific to that area and that property type and all that sort of stuff.
Exactly.
Okay. And so you really are creating wealth.
Yes.
Right? Like it's not like you're buying a property and you accept whatever the rent is and
Yes.
you can't really do much about it. There's all these other rules you got to follow. Here you could actually specifically target things that have a year or less to go on the rent
Absolutely.
or on the lease.
Yeah.
Renegotiate that when it happens. That then can get valued. You have more capital gains. Now you have more equity, which can lower your interest rate and then allow you to leverage up and buy again, right?
And go again.
And that's the big difference between residential and commercial. With commercial, the value is based on the income that you're getting solely. Residential, you can put the rent up as much as you can, but that's not going to have a bearing on the value.
True. Yeah.
It's more related to what area it's in, the type of building, how nice the kitchen is, those kind of things.
Yeah, that's right. The emotional side.
Yeah.
Whereas this is purely I'm sure it's not 100% pure, but it feels like it's way less emotional and it's far more financial.
Yeah.
Those principles really do make sense. But when you're dealing with, because I often deal with people buying investment properties that are residential, there is always this bleed over of emotion into the mathematics.
Yes. Yeah.
And that's what I keep on getting the vibes from you guys with is that it really is mathematics first.
Yes. Yeah.
And if you want to be an investor who does primarily look at the numbers, then commercial is where you play.
Yeah.
Is what I'm hearing.
Yeah.
So, Carl, like when I'm thinking about this right now, I'm kind of, and I think a lot of people listening and watching will be thinking the same way, like, how can I get into this? Like, what's the playbook that I'm going to follow? So there are many ways that people can get in. Can you just cover off the main ways that people can get exposure to commercial property?
Firstly, you can go out and buy your own property. We assist investors to do that, and we manage them, and we help with all the due diligence side of it. So we use our expertise to make sure that you get a good property. So that's direct ownership. So you're buying it, your name's on the title. The other way is you can buy shares on listed properties, listed property funds.
Yes.
So you can go onto the Australian share market, New Zealand share market, and you can buy a few shares, 100 shares, whatever you like. And that, as I said before, that's a really good way to learn about property funds, yields, capital gains, and how it all works. You can also invest in unlisted, that's what we are. So we're purely for wholesale investors. So minimum investment is 50,000. So we've got 14 properties, 23 tenants. Portfolio's valued at 100 million, and we have 160 investors. So they all own a share, or some higher shares, lower shares, in the company that owns all the properties. So that's unlisted. Syndicates are a form of a small fund. So there may be a group of, say, 5 or 10 or 20 people that own a small share in normally one property. The syndicate may have 2 or 3 properties, but they generally get to a size and they close off. So those 7 or 10 people will own that syndicate that owns those properties. And normally that will be managed by a company like us.
Got it.
Yep.
Okay.
Yep.
And so the areas that you can assist people in would be one where you could help them get their own property.
Yeah.
100% just them.
Yes.
Or they could buy into the Provincia fund, which is a wholesale fund. So it's not open to retail investors, but if they had $50,000 and they meet the wholesale criteria, they could buy in. What would you recommend as the first step if people have already done their education, the due diligence, and they're ready to actually part with some capital? What is the very next step that they should take?
It depends on the number. So if they're wanting to buy their own property outright, they can contact us and have a chat with us. We've got a lot of private clients we work with. So that's we do the due diligence, the 38-point checklist. We actually do the acquisitions and we look at what properties are on the market, and we can do all that for the client.
So you're actually buying it for yourselves,
Yep.
right? So if they don't buy it, you own it, right?
Yep.
So you're buying it as a fund primarily, and
Correct,
you
but-
provide the opportunity for someone to buy it.
Correct.
Off you.
Yeah, and so we do a deed of novation. So we novate the contract across to our private client, and we can do any size property on that depending on what suits what they're after. There's a lot of off-market opportunities out there, and we're always seeing that. So that's probably number one if they want to own their own property. If they want to get into the market and start learning a bit more, maybe they've got a little bit of capital, equity tied up, equity to spend, then they can invest in our property fund, which has done very, very well year on year. So I think the last 5 years, our average return, it's on our website, it's 11.1% total return. So that's your cash return, dividend return, plus your share price growth.
Right. And the share price growth is analogous to capital gains, basically.
Exactly, yeah.
And is there a newsletter or is there a website that we can direct people to?
Yeah, so provincia.co.nz.
Yeah.
So you can go on there and subscribe, and we'll keep you up to date with what we're doing in terms of podcasts like this one, webinars, and also you can make an appointment to come and see us. It costs nothing.
Cool. Carl Burling and Jack Revill from Provincia Property. Thanks for joining me today.
Thank you.
Thank you, Darcy.
Cheers.